Hey, this is Hadar from MFI Holding. If you want to learn how to use a small axe to build your empires, you should listen to the Small Axe podcast with my good friend, Nico. It's a must.
Hey guys, it's your boy Nico here from the Small Axe Podcast. I want to show you how to use your small axe to build a lasting empire. You see, not everybody begins their investing career with millions of dollars, a huge network of investors, or the knowledge necessary to become successful in this space, and that's okay. What I focus on here on this podcast is helping you hone your skills, sharpen your tools to become the best investor that you can be. Now, I want you to sit back, relax, and enjoy this show. If you have any questions or you want to reach out to me or the guest, feel free to do so. Love you guys. Hey, Small Axe community, it is your best friend, Nico, and today I'm hanging out with the coolest guy in multifamily, one of my true legend heroes. His name is Hadar Orkibi. We've been working on getting him on this podcast for a couple of years now, and he is so active and so busy that it's been a challenge, but I'm really happy to say that he is here today joining us, and we're going to learn a lot. So without further ado, let's get him on. Hadar, how's it going?
Great, Nico. Thank you for the kind words. Great to be on your podcast finally.
Yeah, I am really excited for you to share not only your story and your journey, but all the knowledge that is sitting inside of you, because there's so much depth to what you know in this industry, and I can't wait to get into it. So let's start with, if you don't mind taking a few minutes on sharing your journey and how you got to where you are today.
Sure. So on a nutshell, I've been doing real estate for 20 years now. I was born and raised in Israel. I started my journey as a real estate agent, licensed real estate agent back in Israel. And in the early 2000s, I immigrated to New Zealand. I started in New Zealand, the real estate path, if you like, through wholesaling, assigning contracts, doing contemporaneous closing, which is double closings, doing things like signing contracts for a fee, and slowly but surely started to build my own capital. So I was able to basically close on deals, and I started flipping as well, renovating and selling, and also buying a buy and hold portfolio. So I mainly focus on multiple income properties, which is a smaller version in New Zealand of what we have in the States in terms of multifamily. It's over there in the States, there are purpose-built communities, 10, 20, 50, 100 units, which are built to rent. In New Zealand, this concept is not common at all. We typically have 4 units, 3 units, maximum maybe 10 units I've seen. So, we got like a home in a granny flat and stuff like that, which we could get a better yield. So I've done that, gradually built a portfolio of multiple income properties, some commercial real estate as well, a triple net lease. I have an asset which is 4 shops. It's a strip mall with an apartment on the top, and it has tenants that pay all the expenses. So about 7 years ago, I kind of got to the point that I have a reasonable portfolio in New Zealand with quite a bit of equity in it, but I felt that I maximized the potential of growing the passive income further, because the price points in New Zealand really increased. So the market matured. It became more like, if you like, New York, Los Angeles, Boston, Seattle, those very low cap rates, very compressed cap rates. So there's not really opportunity to cash flow because the price to rent ratio doesn't make sense. So then I got myself educated in the States. I basically joined a coaching program and got myself educated about investing in a US multifamily. I done the research, I chose the right market, and started investing and building a portfolio in America. As an American citizen, I would like to mention that my mother was born and raised in Chicago. She married my dad, and then they moved to Israel, many years, 60 years ago now. But that was really the opportunity that I had to actually do business in the States. And I travel to the States regularly now for my property acquisitions and asset management, but also for the MIH Mastermind, which I'm sure you're part of MIH, so you know the story there.
Hadar, thank you so much, man. We're gonna continue with this because we're driving right now, and I love this. And we're gonna get into the mastermind. We're gonna get into so many things, but I want to continue right now with You said you chose a market in the United States. Do you mind sharing that market?
Yeah, I personally invest in Arkansas. I've been investing in Arkansas for the last 6 years, a bit more than 6 years. And I also invest in East Tennessee, so around Nashville and East. I got, with a couple of partners, I have mobile home parks over there in East Tennessee, and they're doing really well as well. So basically a mixture of, my portfolio is a mixture of multifamily apartments and some mobile home parks as well.
And why Arkansas?
I like Arkansas. You know, I traveled the states and looked at the various markets. I looked on Jacksonville, Florida, which is a great market. I looked on other growth markets at the time, like Salt Lake City, and I went to Memphis. But really, I felt that Salt Lake City and Jacksonville, for that matter, the prices, the price points, and the price to rent ratio at that time when I started looking over there didn't meet my criteria for my cash flow criteria, because I really wanted to invest in America for the passive income so I can build a passive income and generational wealth. I wasn't interested to buy something that will not meet my cash flow criteria because it's not going to meet my goals. So anybody can go and buy an asset anywhere, which will be like an off-the-shelf asset that doesn't cash flow. I went to see Memphis as well, and over there I looked at the market. I decided that the market wasn't for me. It's really a market that block by block could be a different demographics, and I found it to be a very hard to get familiarized with the market. It's quite a large market as well, very spread out. And somebody recommended to me to go and check out Little Rock, Arkansas. So I drove from Memphis to Little Rock, Arkansas. It's about 2 hours, 2.5 hour drive. And I arrived to Little Rock, Arkansas, and I really liked what I saw. One of the benefits there is that it was introduced to a very good property management company, a third party that I felt that I can rely on. And of course, I really like the landlord friendliness, if you like, that Arkansas has. It has a very, very landlord friendly rules. And, you know, if somebody doesn't pay the rent, you can evict them within a short time frame, relatively short time frame. There's no rent controls, and it's just more pro landlord than other states.
Yeah, awesome reasons to invest in Arkansas. I did take a look at that market as well at one point and just didn't have enough bandwidth because I was already focused, exclusively on the Tampa market. I was trying to expand my markets and I just didn't have enough in me to kind of expand markets at that time. So let's talk a little bit about that PM. So you're not vertically integrated. You have a third-party property manager. Are you still working with that property manager?
Yeah, I'm working with that first property management company. They're great. We're basically doing the asset management. So they are very efficient. We're very happy with them. We just need to do the asset management and make sure that they don't miss out a few things. Like, for example, when we have leases that are maturing, we want to make sure that we are following up with them usually 30 to 45 days prior, advising them whether we want to renew these tenants and what rent we want to take the apartment to on renewal, or whether we want to renovate. So they need to give them notice to vacate. We go and we look through the statement on a monthly basis to make sure that there's no double charging or there is no delinquencies and so on and so forth. Which those are things that we really monitor on a weekly basis. But with this particular first property management company that I hired in Arkansas, close to 6.5 years ago, we don't need to do too much of an involvement in terms of asset management more than what you would expect. But I do have other property management company that I work with over there, because I got another property in Conway, Arkansas, which is about 45 minutes from Little Rock, and my property management in the Little Rock area, which is kind of a few towns around it as well, within 15-20 minutes, they don't manage in Conway. So I had to hire a different company. And over there, I had a bit of challenges with a couple of property management company. I'm on my third one now, but we have someone that is doing a much better job now from the property. And when a property manager is doing a bad job, then that's really creates a situation that we need to get more involved. And we put ourselves in a situation that we almost need to micromanage them. And we don't really want to do that. We want to work with somebody that has system and processes in place. And most importantly, when you are an out-of-state or even out-of-the-country investor, is to have good reporting and good communication. So at this point, we are pleased with what's going on with both property management company. But we are looking for a large enough deal that will allow us to have in-house property manager, which means a leasing agent in an office, that and a maintenance guy, for example, that will allow us to really have more of an in-house management with systems and processes that we believe would be the best practices that we can implement. So we're hoping to have an acquisition in the next year or two that will be 100 units or so, maybe 90 or 80 units, typically something with an office that we can have a leasing agent and maybe an assistant leasing agent, and really control the process even a bit tighter than what we got now. So that's kind of the goal for the next couple of years.
Awesome, Hadar. I'm going to slow down for a couple of minutes here because I know that with what you were saying in there, there's some really great questions that my listeners are going to want to know answers to, and you're the guy to ask. So you mentioned in there that you had to change property management companies. At what point because this happens to me all the time, I get people reaching out saying, my property manager is not doing X, Y, and Z, and I don't know if that's what's supposed to happen. So at what point did you feel like you needed to cut ties? Were there any indications that are like, what were some things that stood out to you and that we should be aware of as operators to look out for with property management teams that might be failing?
Yeah, there was mistakes with the statement, regularly mistakes with the monthly statements. I don't think they were trying to steal money, but they were just very disorganized, and they didn't have enough system and processes in place. So there was a lot of mistakes that we unrevealed in the statements on a monthly basis, and had to trace back, where the money's gone to, and various things like that. There was lack of communication. There was lack of ability to be flexible on showing the apartments to, when there are potential residents that wants to come and show them, for example, on the weekends and or after work and stuff like that. Some people cannot come 9 to 5, they're working. So various things like that, mainly communication, increase in delinquencies, and increase in tenants which behaved in a way that they do not respect the property management as a management, as an authority that manage the community. And when we see that, we know that it's lacking. It's lacking hands-on. They're not visiting the property enough. They're not looking up for trash. They're not looking up for things that will enhance the experience of the resident, in opposed to you want to make sure that they're enhancing the experience. They're trying to make the resident feeling that they're living in a nice community, in a safe community, that the ownership or the management care about the resident. And we just felt that that particular management company, they were just not cutting the mustard in that way, not doing good enough job. So we regard our residents as our customers, and we really want to be able to provide them with a good experience, and it needs to meet our standards on those bases.
Awesome. And for the listeners out there, you provided me, Hadar, with a really nice asset management template that I implemented. I have another one as well, but I really liked how in-depth and detailed yours is. It really helps you keep an eye and a close watch over exactly what's going on in the property. Now, I want to backtrack again because you have closed a lot of deals. Now, do you syndicate or just JV?
I will answer that. I just want to mention that, yes, we do monitor what we call the KPI, the key performance indicators, KPIs, which that's how we track the performance of the asset, and we keep the property manager accountable for those key performance indicators. A good property manager will understand the KPI and even be cooperating to provide those indicators to you. So that's very important. And we do have an asset management course through the mastermind that I know you've done, and we also have one for $47 for sale on the MIH Mastermind website. If anybody wants to take a look, I'm sure they will join. You'll gain a good experience from that. Now, to answer your question, I'm really more interested in syndication. I'm really more interested in joint ventures. This is something that I like to do. So far, when I started in Arkansas, I purchased about 100 units on my own, totally on my own. And my role and my experience starting as a as a flipper and a wholesaler, if you like, back in the day in New Zealand, nearly 20 years ago, really allowed me to have the mindset and the ability to create deal flow. And not only create deal flow, but also I'm good at broker relationships. So in the MIH, we teach the three pillars of deal flow. We teach the broker relationship, on and off market deals. We teach the direct to seller and networking. So I'm quite good at creating deal flow and stabilizing those relationships with the brokers and also with the lenders, which allows me to create deal flow. And if I'm able to create a deal flow, I'm able to pick and choose the size of the deal that I want, whether I could invest on my own or whether I will invest with maybe 1 or 2 or 3 other partners. So my journey in the last 6 years was specializing on the apartment building, which were typically under 60 units. I found them really good. A lot of them are owned by mom and pop investors. So, you're able to pick them up for a good price, because a lot of them are mismanaged, or they have loss to lease, which means that the rents are well below market. When that allows us to add value to the property through renovation and through improving the operations, reducing the expenses and increasing the income, creates a higher net operating income, NOI. And this way we were able to buy assets, improve them, then refinance them, pull the capital out and invest it into the next deal, that's what we call the velocity of money. We take the capital from the first deal, we refinance, we improve the property, we refinance, and then we go ahead and we reinvest the capital. That was our strategy and my strategy for the last few years, and it served me really well. And that's why we are not in a hurry to go and buy any asset just for the sake of making money through a syndication, for example, through clipping up the fees, the acquisition fees or the asset management fees. We are not interested in that. I mean, that will be a good bonus if we get a larger deal, a 100 unit or 200 unit, that will be anything from $8 to $15 million deal, for example. We have to syndicate something like that, or maybe do a large JV with a syndication legality in the background of it. But we are not looking for those fees per se. We are looking for long-term generational wealth and passive income.
I love it. Thank you, Hadar. Now, what asset class do you typically focus on? Is it A, B, C, or all?
I started with the C and B class assets. A type, just to make sure that the listeners understand, typically A type will be a newer vintage. The A type could be anything within the last 2-3 years of construction, and then you go backwards from there. So there's different ways how to define it, but most people will say that an A-type asset will be a newer construction, very recent asset that usually typically requires less repair and maintenance. A lot of my great deals were kind of C to B type assets, 1980s, 1990s vintage, early 2000. I will call that the B type, B plus. And that's what we specialize in, workforce housing type. But in saying that, we also adapt to the market and adapt to the stock that is available in our market. I'm only focusing on 1 or 2 markets, as I mentioned. I'm not looking all around the country, because I believe that to be a good investor and to get great results, one need to become an expert in the marketplace. So they really need to understand the market intimately. They really need to cultivate relationship in those markets, to be able to not only get the opportunities when they come available, but also to recognize an opportunity when it comes across your desk, so you're able to make a fast decision. So that is the key, and that served me well for the last 20 years of doing real estate. Being an expert in the market is the key. So to answer your question, I like investing in that particular market, and really I'm going to stick to that as much as I can.
Yeah, Marco always says it too. I mean, speed wins, and I agree with you. And you can't have a great offer with speed if you don't know the market very well. And I do the same thing. I mean, I've spent 3.5 years now focusing on one market, one fairly large MSA down in Tampa, and it served me well as well, although it is extremely competitive. Now, Hadar, for people who are, I guess, searching out or seeking out a market, what things should they be looking for when they're doing their first search?
It really depends what kind of market you want. So I did mention that I did the research on the markets when I came to the States. for the first time. But for me, the price to rent ratio was very important, and Little Rock had that. Now I would like to say, and it's not a secret anymore. I mean, there are a lot of people coming to my market from other states, low cap rate states like California or New York, and they come and they beat the prices up. So I can, the cap rates recently compressed, and the returns were much lower than when I started because there's more competition. You see, and that's just what happened. It's the nature of the beast. There's a lot of competition. The competition creates more demand, and that increases the price and reduces the returns typically. That's why we don't buy anything that we see. We have a lot of people who come in from out of state, and they think that they're getting a bargain, which we think they're overpaying, because we know what the market used to generate before that. But now we are a little bit in a different economy, so there are some other opportunities. To answer your question about what to look into a market, I like to have a market that is steady as she goes market in terms of job growth and population growth. That's very, very important for me. Now, if you're going to go, for example, in Jacksonville, Florida, or if you go to Dallas, Fort Worth, Dallas, Texas, you will be in a market that there is a lot of job growth and population growth, but there is also a very strong demand, and the cap rates are very compressed over there. So it's finding the nice balancing act when you can invest in a market that will still have a reasonable price to rent ratio and cash flow with a reasonable population and job growth. It doesn't go together. A market that has a massive job growth and population growth, like Austin, Texas, like Dallas, Fort Worth, like Denver, Colorado, for example, those markets are great. There's a very good capital growth prospect and rent growth as well. But everybody already jumped on the bandwagon. Everybody knows that. And basically, their returns are much lower than the market that I'm looking at, because I'm looking in the market that will allow me to create the passive income that I need so I can live the lifestyle by design that I aspire to have and have. So sometimes it could be one deal that will make a hell of a difference in your financials. One great deal, large enough deals, could suddenly generate $5,000 to $10,000 a month of passive income if you bought it right and you implemented the strategy correctly.
Cool. Thank you, Hadar. So like me in Florida, I'm looking at deals all the time. I look every day, and I'm offering and negotiating with literally every single day, and pocket listings coming my way. Brokers take my offers and then they go shop them around. I know this game, but when I'm underwriting a deal and I'm looking at deals down in Florida, I know that there are a couple things that I basically don't even need a T12 to figure out what the expenses should be. But something that really is important to note down in Florida is insurance. And within a year, it more than doubled, essentially. I used to underwrite for $800 a door. Now I underwrite for $1,800 to $2,000 a door if it's not even in a flood zone. And I was told by a close friend of mine who has ties with all the brokers down there and even Lloyd's in London, that it's going to increase another 25% next year. And if we have any crazy hurricanes again, then we're in trouble. So we need some quiet seasons. But my point is, in Florida, I know that I have to watch out for insurance and be spot on with it. Is there anything in Arkansas that you need to kind of watch out for, or how is insurance? What is it like over there?
Insurance, when we started there, insurance was also $450, $500 a door. Now it's doubled. So now we are roughly about $800, $850. Even more, depends on the apartment community. We just had a tornado over there that ripped up through a big part of the town, so of Little Rock itself. So I think it's really, really important to keep an eye on insurance. It has gone up a lot by 25 to 30% in the last 2 years. Unfortunately, it really hurts. We have received some underwriting from brokers who presented us with deals, and their pro forma and underwriting were insurance at a much lower level, and we had to inform them that they're out of town brokers, but a lot of the deals in that area, it's actually through and out of town brokers, because they are prospecting a lot over there. So yeah, we have to correct that. Insurance, it's a big thing. Taxes are not so bad over there, because taxes in Arkansas are assessed every 3 years, and there is a limit on how much it could increase. So that's quite a good thing. I think the main thing is insurance. I think that rent growth in the next at least 2 to 3 years is not going to be as big as we experienced in the last 4 years. I think that's something that we need to keep that in mind. And that's another nationwide issue is interest rates. Where interest rates are at the moment, you want to make sure that everything pencils in and you're buying a property that has a reasonable debt cover ratio. So depending on your lender, for example, Freddie Mac, for example, which is an agency debt, which is typically a really good terms. It's a non-recourse debt, 30 years amortization. You can have typically a lower interest rate than a community bank or a credit union. They required Little Rock metro area to be at 1.3 debt cover ratio. So more often than not, when you buy an asset which is distressed or has a significant loss to lease, which is what we like, you will have a situation that the rents are not high enough comparing to the price you pay to actually have that debt covered ratio at the front end. So more often than not, we can mitigate this risk by just going with we're not going to go to agency because this is like more of a permanent debt. We like to see that as a permanent debt once the property is fully stabilized, and that's what they require. But we can mitigate that risk when we're going with a community lender over there, the regional bank in Arkansas, by maybe providing some reserves. So they take a hold on a reserve, maybe 6 months or 12 months of operating reserve, or maybe a principal and interest, and they just put it in a deposit like a CD and in an account that you can't withdraw it until you reach that the threshold of the debt cover ratio. So that's something that people should certainly consider when they're investing anywhere in the States these days, because interest rates make it really hard to hit the debt cover ratios that are required.
Wow, Hadar, awesome advice. And typically you're going to be coming out of pocket either to fill that reserve requirement or drop the LTV so that you can get that debt service coverage ratio to hit. Hadar, I wanted to ask you something. So I know that we're already over time, but I got a bunch more questions and we're going to keep rolling if that's okay with you. Yeah, this is important and quality stuff here. I know that you have a great outlook and a great perspective on market cycles. Where do you think we are today in the market cycle?
It's a very good question, but it's hard to answer because I don't have a crystal ball. And you know, COVID was an anomaly. It was an event that nobody predicted. Nobody really knew how we're going to get out of it. In the end of the day, we actually ended up being in a stronger inflation because of COVID, which created even more of an asset bubble until the Fed started increasing interest rate in the fastest ever rate in terms of, you know, increasing it for where it is now. So I don't really able to answer it, but I think that we are pretty close to the peak of this recession or the bottom of this recession, in my opinion. And I'm only talking about the multifamily space. I'm not talking about economics, general economics of the whole country or other sectors, because when you look at real estate as a whole, you also have an office sector, you have an industrial sector, you got a retail sector, and you have multifamily, you have mobile home parks, you have self-storage. There's a wide range of sectors that could be affected differently. So whatever is interests me specifically on the micro situation will be the multifamily situation. And in my view, I don't see a lot of distress in the market yet. I think they're going to be distressed, especially now in the next 18 months to 2 years when a lot of those bridge debts are maturing. It could create some distress. But I also know that there is a lot of capital on the sideline waiting to buy. There's less than what it used to be, and banks are still lending, but obviously the appetite is not as high as it used to be a year or 2 years ago. But I think that there's enough capital on the sideline, and I'm seeing it in the market because we're underwriting a lot of deals. We are regularly talking to brokers, and we see that for any deals that we're looking at, they'll still have other groups that are willing to pay a premium, whether it's a 1031 exchange or whether it's people who just see the value. But just, you know, you mentioned earlier that to make the debt cover ratio work, you bring a bigger down payment. Now, Freddie and Fannie agency debt, they actually adjusted their criteria. Some deals, they're actually required for someone to bring more down payment. For us, it's an option to get into the deal, but it's also something that you have to take into account that when you go with Freddie and Fannie, for example, you are going to be able to, you'll need to leave the money in for a longer period of time. Usually that's like a 5 to 10 years debt, at least. So unless you can get a supplemental loan with Fannie Mae. So to answer your question, I think that for the multifamily space, we are we pretty much reached the bottom, that we haven't really seen a lot of distress yet, but let's see what happens. They're going to trickle down. They're going to be a bit more distressed that we hear about people that make the mistake and they didn't analyze the deals correctly. They overcommitted. That's tough luck. I mean, that's too bad. They should have been more conservative. And a lot of those will be syndications or people that they were greedy and they were looking to buy a lot of assets. I know that talking to local community banks in my market, for example, I know that a lot of them are in communication with the owner, and they will try and work with the owners or property owners to not have a default or situation that they return the property to the lenders, because the lenders don't want to manage the property. They rather see them on their books but performing. I also know that a lot of bridge and people who are going off the likes of Lima One and those higher interest rate bridge debt, not community bank bridge. I know that when we were buying at 3 to 4% interest rate, they were at 6.5. Now the interest rates are double that for the bridge. And so a lot of those bridge, if they can, they're going to go to agency and they're going to do what we call a cash in refi. They're going to refinance the property, but they're going to recapitalize the deal, and they're going to put more money in the deal. Maybe they're going to do capital calls. Maybe they're going to if it's not a syndication typically it's a capital call. You're calling the investors to bring more money into the deal. If it's a JV, then maybe they will bring more cash into the table to help in that stage. But I think that there's still a lot of rescue capital on the sideline. And I don't think the multifamily is going to suffer as much as they did in 08 and 09. I think that if we stick to the fundamental of our underwriting and we're sticking to have enough reserves and we got the good debt cover ratio and cash flow is the most important thing, I think we'll be all right. And we're still looking to buy, and we're still making offers all the time. So to answer your questions, I don't know. There are different chain of thoughts. Some people are saying that in 2026 and 25 we're going to reach the peak, and then they're going to get another downturn coming. So there's different cycles. There's cycles that goes for 10, 15 years. There's cycles that go for 30 years. Nobody knows. And my theory is that because of technology and because of the global change with communication and global change with financing and various other things that just evolve as humans evolve and as the financial sector evolves in the world, things are changing, and things might not be exactly the same as they have used to be over the history, over a period of time of history. So in my view, things might be a little bit different. The most important thing is to stay in touch with your lenders so they will lend you money and will work with you if you have a difficult situation. Because once we see the lenders further tightening up their lending, that's when things are going to be more difficult. At the moment, lenders are still lending. And if that's going to get more tight, like yours used to be in 08 and 09, then we are in trouble. But until that happens, I think multifamily, it's a pretty safe.
I agree with you, Hadar. Thank you. And I've also been talking to a lot of people, obviously, on the show and just in our communities, that there's a lot of pref equity out there that's ready to come in as rescue capital, as you were mentioning as well, aside from the capital calls that syndicators are going to have to do, or people are just losing their investments, which is just a terrible thing. And I think that it has a lot to do with the overconsumption and overproduction of operators, because there's so many mentorship groups out there, so many programs out there that are not necessarily doing the right thing, not teaching the right way. And people are out there with just kind of slinging guns and just taking wild chances and overpaying. And I think that is a big reason why a lot of these properties have gotten overbid and we're in this predicament. But I bring this point up for a reason, because I wanted to spend a few minutes before we get out of here talking about your particular mastermind, which I am a member of and I love and I truly believe in, We have a very tight community. We have a community of people that help and support each other and that care about each other and that don't let, so like I had my deals reviewed by Chris Jackson. I've had my deals reviewed by Hoon. We've had conversations with you and with Marco, and people check out what I'm doing before I get into something dangerous. So if you wouldn't mind sharing for a few minutes a little bit about how your program works, that would be wonderful.
Thank you, Nico. And that's something that I wanted to mention. Just I tend to think about so many things that I want to say generally when you ask me, so I know we're limited for time, but what I wanted to say is that the key in today's market, and that's something that we really encourage in the MIH Mastermind, as you just mentioned, and I wanted to mention that before even, is that underwriting the deals correctly is one thing, making your assumptions because you know the market and you're assuming where the rents are going to be, what's going to be the taxes, what's going to be the insurance, and so on and so forth. How many units can you turn? What's going to be the cost to turn those units, renovate those units, how fast it's going to take. That's very, very important. But what I like about us in MIH, first of all, as you know, Marco and I, we are focusing on quality over quantity. We don't want to grow this mastermind for 1,000 students and not have the personal touch that we currently offer in MIH. So Marco and I jump on call with members all the time. We do strategy calls and we review their deals. And that's the value. You see, I tell all the MIH member guys and girls, we got many females in the mastermind doing a great job, and teams. We create teams together within MIH. It's an ecosystem of deal finders and deal sponsors. So I tell the members, before you commit, before you even do deals with each other, come to us. Let's discuss. Let's look at the underwriting. Let's do an underwriting review just to make sure that it's safe. It's safe and you're doing the right assumptions. So as you mentioned, Hoon, which is one of my partners and he's a structural engineer, is the chief underwriter with my company, which is the website is mfiholding.com, holding with the G. He's doing a great job. He goes, he underwrites, he analyzes the deal, and he can make a decision or make comments based on market research. He really enjoyed that. It is really good with that. So it's very important to be able to really have this stop check and a review. A lot of people went in to do the coaching programs just because they had a group of excited people. They believed the hype. They put the money into deals, but the operators did not have enough experience to actually implement the business plan. And we're starting to see that a lot. I actually talked to Marco yesterday about a couple of other coaching programs that have members in them that are starting to fail. So I'm not going to make any names, but we're keeping an eye on that because we are really trying to minimize that with MIH. We're trying to be there for our members, and if there is an issue, if there is a challenge, because sometimes there are more delinquencies, sometimes there are more challenges that needs to be addressed, we want to catch it early on and really help to stabilize the situation. Now, to answer your question, the MIH Mastermind, like I said, it's an ecosystem of deal finders and deal sponsor. We have people from the East Coast or the West Coast that living in a market that it's not great for passive income generational wealth building. So they need to work with a team that maybe with the boots on the ground or a team that is operating in a market that makes more sense. And that's what we do. We put the teams together. We remember the 3 pillars of deal flow: broker relationship, on and off market deals, direct to seller, and networking. Networking is a very big part of it. So we basically educate our members. We got 12-month sessions. So every month, first month is setting yourself for success. We basically helping you to create your quarterly action plan with the 3 focus area that you're going to focus on. We help you to create a vision board because that really stands out there. That is your why. In my case, I had on my vision board a certain amount of income. You can see it here it's actually behind me. There's the property, there's the income goal. Underneath that is kind of a well-being. It's more like want to do more meditation, want to do a half a marathon in Little Rock I wanted to do, and I did that, and maybe do some more yoga and things that I enjoy to do. And the last one was a lifestyle choice, which was I want to go and live on an island near the beach. And as you know, last year, me and my family, we went to live in Fiji for 6 months, which was an absolutely amazing experience. But it was on the vision board, because the vision board is really solidifying your why. It's in front of you. I have one in my office. I got one in my bedroom. And that's important. So we set yourself up for success. We connect you with the right people. We figured out which market you're going to invest in. And then we pursue through the other lessons. For example, we had another lesson about networking and attracting capital. We got negotiation. We have things like syndication. We teach about asset management. We teach about the property cycle. We teach about many other things, as you know, how to create deal flow, and so on and so forth. So those are lessons. People come, they sign up, they join the MIH, which is very affordable. They join in for a year, but they are in it for life. So people go and they join, they pay the fee for 1 year, but they're in it for life. So we all, as long as you want to stay current, and as you know, Nico, you joined a few years ago now. You were one of our first client, members. And you in it, you still interact, you're still coming to event, we still do meetups when we do meetups. Last time in New York, remember we met in that place, we met a sushi place with some MIH members, and we're doing one or twice, we're doing other small event, very hyper focused quality event, 100, 120 people, sometimes 70 people, whoever can come to Florida, or we did one in Cincinnati. We did market review, and we went with Jaideep, remember, to look at his deals and his portfolio with his team and his partners. And we just really nourish the relationship and work together as a family. And that's what MIH is. Our motto, if you like, is family first as well. So we run it as a family, and our most important thing is to have a family atmosphere, but also for people to understand that we want them to prioritize their families and their loved ones as a first protocol. And that's the reason most people join, and that's why most people do MIH, to have more freedom of time, to spend more time with the family. I know you really want to take your daughter to Africa, to the safari, and I can't wait for that to happen.
Oh man. So, well, here's something interesting, Hadar. 2 things on my vision board are coming to fruition this month. So I'm finishing up the apartment upstairs to help me generate more passive income for my family. And me and my daughter are going to Spain next week for the first, she's never been. So it's going to be her first trip to visit our family in Spain. And all because of this, the conversations with you guys pushing me, saying you can do this, you can make this happen. And man, we're making it happen. So thank you, Hadar.
Absolutely, Nico. One of the greatest delights in the days, Nico, that I want to tell you, and I know I told you that as well before, is that when you got that great deal in Florida, you and Bob and that. So for me to see you joining MIH and hustling hard and really putting everything you can with the podcast and your show, and with the work that you put to create deal flow and how you network with the brokers and really invest yourself in the system and everything. For me, when you closed that deal, Nico, for me it was a very, that's the reward that we get. It's not only the monetary reward. I'm happy and so happy and grateful to see people that we help them to succeed and achieve their financial goals.
I truly felt that, Hadar. I felt that when we hugged that day that we met up in New York, and you were just so happy that we made this happen. And I felt that it was like an accomplishment for you as well. And I truly felt that connection. So thank you for that, man.
Absolutely.
All right, let's transition to our final question, and then we're going to get listeners some form of contacting you. Okay, Hadar, let's imagine it was 100 years from now. You have great grandchildren and they're as happy as can be, and they wanted to write a book about you to honor you and your life. What would you want them to title this book, or what characteristical traits would you like them to highlight about you and your life?
I don't know about title yet. Just I need to throw few things out into the air here, but I think that few things that I could say is that I'm an extrovert. I'm a people person. I like to talk, as you can see, and I like to share my experience. I'm also I'm really good with money. It's just every person's got something that they're good with, and I think that I'm quite good with making money. It's just one of the things I enjoy it, and not only that, I enjoy it because I'm also enjoying the process, and it excites me. I already achieved my financial goals through one of the deals that I bought a few years ago, and I have to keep increasing the number on the financial goals on the vision board. But the point is that when you do something that you like, you really get, you're really gonna get the results as long as you got the infrastructure and the network to support you and the guidance. So I was grateful enough to have Jake and Gino as my mentor, as you know, when I started in the States as well. So I think like things like my granddad was great with money. He was a people person. He could talk to anybody in the street. My kids always tell me, if you go and pick up something from the store, from the supermarket, don't start talking to everybody over there. And I just like to talk to people. I like people. So that's number one. Number two, recently in the last year and a half, I actually escalated it a bit more. I started that, my wife and I started to do quite a few years ago. We and I'm not bragging, but you asked the question, so I'm going to say, I mean, we try to help people. So we try to help people in a way of making a difference. So we have a few people like in Fiji that we met, and a few other people we met in India that we really help them financially to try and better their life. In some cases, like a Fijian friend, for example, we didn't actually help them. Well, we did help the process of helping him to come and find work in New Zealand, which is a life-changing event for him. And now we're helping his wife to come, and then the kids were going to follow. And this is something that we not only invested financially in, but also know that it's going to make a massive difference. So for me, as a generous person, if you like, with a big heart to help people, and I get a lot of satisfaction out of it, being able to do something that for me it's not that much of a big deal, although it takes effort and it takes some financial effort as well. It takes planning, but for me, it makes a massive effect on somebody's life. And I'm even had a chat to my assistant Larry. She's in the Philippines, and I told her, Larry, when we're buying this, when we're going to buy, she's been working with me for 3 years now, technically, even more, close to 4 years now. When we're buying that apartment community and we can have staff and we'll have enough doors that we're able to have an on-site team, I told her, Larry, start looking on the possibilities of immigrating to the States to work for us over there, because she knows the business inside and out. She's been doing the asset management with me for 3 years. So, and that's something that we prepare to do for people, and her and her husband, and just to better their life and really do something that it has a massive impact on their life. So I want to do bigger stuff slowly. I got another friend in Fiji that we hopefully, fingers crossed, I'm applying for a kind of a business permit over there to start a business with him. I got a small boat over there, so I'm going to do like a boat water taxi business with him over there, island hopping, and in Fiji. And I know the guy for quite a while, and we became friends, and I want to help him. He's got 5 kids, and people struggle, and if we got the opportunity to help, then I think it's going to be a very good thing to do. And that's what I want to do. And I want to encourage anybody that is listening to this, if they have the ability to help someone, whether it's financially or whether it's not even financially. Like I got a friend who is going to elderly people houses, Ian goes to elderly people houses once a week, and he's helping people there, just talking to them, helping them, and just being a company, even something like that. There's no mandatory, you don't have to put your hand in the pocket to pay for anything. You can just go and spend time with people. So I want to encourage people who are listening to this show, what are you able to do? I'm not saying what you've done. Let's start fresh. What are you able to do to help people and make somebody happy and maybe try and change somebody's life to the better? Because that's how the world is. We need more of that, and we need to try and help people as much as we can. I think I get great satisfaction out of it.
Hadar, that is the pinnacle of life. That is what life is all about. And that's where we feel at our best. If we can help others and share and spread love and give everything that we can to others, that's where we feel our best. So thank you so much for sharing, man. All right.
No worries.
You're the best, Hadar, man. I could literally talk to you for hours, and there's so much information in your head that people are going to have to reach out to you. So how can they get in touch with you?
Anybody could reach out to me via Facebook, Messenger, or via our website, which is mfiholding.com, or via the Mastermind website, which is MIHmastermind.com. But again, Nico, you can always reach me on Facebook. And that'd be great. So, I mean, if anybody wants to learn more about the mastermind or just want to talk about real estate, multifamily real estate specifically, I'm always happy to chat and open and share my experience.
All right, Hadar. Once again, thank you so much for joining me today. It is a true honor and pleasure to have finally gotten you on. And next time, it won't be 2 years, so we'll do it in a year or so, or maybe 6 months.
Absolutely. Thank you. Thank you, Nico. Have a good day.
All right. Hey, Small Axe community. I would like to say thank you for listening to another episode of my podcast, where we show you how to use your small axe to build a lasting empire. Now, if you liked what you heard, it would mean the world to me if you would subscribe, leave a 5-star rating, and write a review. Also, if you want to get in touch with me, go to my website at smalaxecommunities.com. Book a call with me. And until the next episode, keep sharpening those axes.